Good afternoon, this is Todd Colvin coming to you from the floor of the CME Group. We are looking at rates, and yes, those 10-year note yields finally got to 3%, finally held above 3% for most of the day anyway. We saw kind of a resurge of selling come in when we looked like maybe things were going to tilt the way of higher yields, and the trend is still there, but we were unable to really see a big move. We got as high as 305. I think that right now that we're kind of still in the waiting game, maybe needing a catalyst or some kind of a push to take us back, towards 320 or possibly take us back towards 270. And lo and behold, this could be the week. Market volatility as we approach this expectation had been declining. Once we reach this expectation, things start to get a little firm again, as they should, because right now the market has kind of gotten where it's set out to get. And now if it goes back down or goes up in yield, it's kind of going against the grain. And that's going to kind of get volatility to bid. So right now, volatility bidding. Also, we're seeing short-term interest rates. Very short. Look at the 1-year and the 2-year yields. Those are really starting to creep up. And if you look at the 1-year yield noted today at around 2.25, with 10-year note yields just over 3%, I mean, there's not much there as far as risk goes. You can hold a 1-year note for 9 years less and get, pretty much a pretty good chunk of that 10-year yield. So right now, those short-term interest rates are really what's digging into the equity sell-off. Obviously, equity yield, the S&P yield is just below 2%. So that's actually not even as attractive as it had been over the years when we saw equities rally. So some of the luster, higher rates is now really starting to reflect the sucking out of money and into lower risk, higher yielding bonds in the Treasury market. And that's one of the reasons why we're seeing kind of a choppy trade in equities, as well as kind of a steady trade towards higher yields is kind of been waiting for. Those stock buyers are now moving their money out, and probably we'll see things level off here. But lastly, what could be that catalyst? What have we been talking about? I think really for the last 2 to 3 weeks. Friday's number, advanced first quarter GDP. And if you look at the GDP Now statistics, they had it as high as 5%, down to as low as 1.8% at one point. So that's kind of a drastically large window. Expectations are really hung at about 2.2%. Now, what will that bring us if we get to 2.2%? I don't think that gives us reason to push yields higher. I think it probably sees things soften, gets us back into that old maybe 280 to 290 range that we've been so accustomed to. If we see a GDP number north of 3%, certainly that would be the fuel we need to push us higher. But a print below 2% would certainly take us not only back into that 280, 290 range, but I think it would really take us down closer to that 280 level that we saw not too long ago. So right now, GDP could be the catalyst that the market is waiting for, in rates anyway. And I think that could be what pushes us one way or the other. If it doesn't, we still have an FOMC meeting coming up next week with employment after that. So there is still a lot going on in the next week or so. However, we get through Friday, things could look a lot different if the numbers aren't as expected. So right now, 10-year note yields hitting their 3% target. But where does it go from here? We could have to wait until Friday. This is Todd Colvin coming to you from the floor of the CME Group.